Very good morning, one and all distinguished guests, ladies and gentlemen. Before I begin, let me just congratulate the organizers on the very successful conference thus far, and I wish to thank them very much for the kind invitation to be here and speak this morning. It's my privilege to be here. I always feel a little odd when I have to comment on Europe in front of Europeans. Makes me feel like an outsider trying to know more than I should. But nevertheless, I have been asked by the organizers this morning to be open and candid with my comments, and indeed I hope to be so. And I say comments because I have no slides, which might not be a bad thing this morning. But my intention is to hopefully give an honest interpretation of how investors such as ourselves at GIC, and more generally financial markets, how we regard Italy, and in doing so to spur meaningful discussion at the panel session later on. Now, unlike my esteemed colleagues before me, my comments will be, as Marco mentioned, more from the macro angle. I should also stress that my comments should be taken in entirely personal capacity and not reflective of GIC's views. Now, this is what I propose to cover in the time I have. Now, in keeping with the title of my session today, which is, if I can recall, Italy amid a European Renaissance and investment perspective, I propose to begin with a few words about how investors like GIC think about Italy, which, fairly or not, still remains within the context of how larger Europe is faring. Now, that being said, we do have increasing evidence going forward that there is scope for financial markets to better differentiate between the various countries in Europe, which was my next point. What Italy can do to distinguish itself as the region begins to recover. Finally, let me conclude with a few points about long-term investing from a GIC perspective. So, let me start with what is hopefully an obvious point. The relationship between Italy and Europe, as financial investors see it, is a symbiotic one. In other words, each is mutually important to the other. Now, from an investor's perspective, there is no euro without Italy, and conversely, the prospects for Italy dim quite significantly if its membership in the euro is questioned. In short, a healthy euro is necessary, albeit not sufficient, condition for Italy to do well. Now, consider this. By and large, it's now widely acknowledged that it was a mistake that sovereign bonds across the Eurozone were allowed to trade in lockstep during much of the euro's first decade. Why? Let me go on. But when yields started to diverge from roughly around 2009, that also happened to be the point where the crisis started. And why was this? All because of doubts as to the euro's sustainability. Now, over the past, I would say, 12 to 18 months, as we see sovereign bond yields starting to converge once more, most of us would regard this as an improvement. The point of it is this. Although investors and financial markets no longer trade all of the Eurozone's countries identically, which is realistic, the integrity and sustainability of the single currency is still the starting point for its constituents to do well. Now, much has been done in recent years to reinforce confidence in the euro. And thankfully, I would say the worst of the confidence crisis now seems to be past. However, and I cannot stress this enough, there is no room for complacency. Just as countries work extremely hard during peacetime, Singapore included, to avoid war, so too, more needs to be done during this period of relative calm in the financial markets to avoid a re-intensification of the Eurozone crisis. And I think it is here that Italy can contribute greatly. As one of the largest countries in the Eurozone, Italy plays a crucial role in fostering a stronger monetary union. Indeed, it is for this very reason that we observe Italy's every move, be it in politics, fiscal consolidation, structural reforms, or on the real economy, being scrutinized so closely by the media and financial markets. So, what can Italy do to strengthen the euro's and hence its own destiny? I would highlight three imperatives. The first is that Italy needs to leverage on its size and influence at Euro-level discussions. We know, obviously, that Italy was key in policymakers' decision to realign policies and measures to focus more on growth instead of austerity, and I will discuss this more later. And this was obviously a major turning point in reversing the course of the euro crisis. And certainly, even here, more needs to be done. But looking ahead, other key developments, such as discussions on banking union, specifically on establishment of the Single Resolution Mechanism, or SRM, and other forms of risk sharing going forward, can only benefit with Italy pushing hard in the right direction. I will not dwell any more on this, but I will be happy to talk about this in the panel session later. However, any talk of joint funding or backstops at the euro level, that is, can really only happen if Italy itself presses ahead on what I would term the domestic imperatives. And these include accelerating reforms by creating policies aligned with the correct incentives, the labor market, for instance, which I'll also touch on later, achieving fiscal targets, as well as improving competitiveness. Here I would just like to add one point. It is, of course, for investors at least, a significant positive that policymakers now realize the need for a balance between growth and austerity. And indeed, this is a major reason for financial markets being considerably less volatile over the past 12 to 18 months. But quite importantly, this commitment on the part of the European level leadership needs to be matched by commitment in each of the member states. Indeed, what financial markets fear is that euro leaders and creditor states, having already conceded quite a fair bit on the pace of austerity, now have little room to concede further if the quid pro quo from member states is perceived to be lacking. If such fears are allowed to fester in markets, the risk premium attached to European risk assets in Italy, but more widely in the euro area, could rise again in a hurry. Which leads me to the third imperative. I would suggest that more can be done to clarify the role of euro to society. And here I would add, the point applies not just to Italy, obviously, but more generally throughout the rest of the euro. The euro's value is far more than economic. It is arguably more important in its role as a geopolitical anchor that benefits all constituents in terms of enhancing security and in furthering the euro area's interests on the world stage. A wider appreciation of this throughout society would greatly assuage financial markets' fears that the euro is merely a political project of the elite that is not shared by society. And here, in a discussion that I had earlier with Marco, it's worth sharing just by the side. Quite often, and this is again my personal observation, sitting as investors here as we do on the other side of the world, I personally am quite surprised, honestly, by how much the discussion tends to be about the economic sustenance or sustainability of the euro, without regard for the euro's value in a wider context. And a lot of this really stems from the sense that popular pressures tend to give voice to political tensions, and that's what, perhaps more than many other things, tends to play very deeply into investors' fears as to the fortunes and the prospects for the euro. Now, thus far, I have talked about Italy's role in furthering the stability and growth of the euro area. My second point is about differentiation in the markets, and as such, the opportunities for Italy to distinguish itself relative to other European markets. Now, let me motivate this by presenting just a few statistics. I know it's early on a Saturday morning. If one observes the correlation of sovereign spreads between the periphery of the Eurozone, what investors tend to call the periphery anyway, versus bunds, you find that thus far in 2013, these correlations have declined quite considerably, by in fact more than 30%, compared to the 2010 to 2012 period when the crisis was at its worst. I told you it's early on a Saturday morning, so let me summarize the point. It's quite straightforward. As tail risks begin to subside in Europe, markets are now starting to differentiate more finely, more granularly across the Eurozone member states. This is both a risk, as I suggested earlier, but as well as that, an opportunity. I note in passing here that the Chinese term for crisis, some of you may know, is made of two characters, wei ji. The first character, wei, means risk, and the second, ji, means opportunity. This is a useful way, I think, to frame the way forward for Italy, because Italy really, as most other countries in the Euro must, decide which of these two roads it wishes to follow in the years ahead as the Euro crisis continues to abate. It can choose to play it safe, as it were, and risk mediocrity, or to press ahead and exploit the many opportunities that can arise as Europe continues to heal and as investors such as ourselves look for outperformers. Now, before I turn to some suggestions as to what Italy can do to capitalize on this market differentiation, let me first note that Italy already has many positives going for it, which markets are now, I think, slowly beginning to appreciate. What are they? Now, here I will make some deliberate comparisons with large countries such as Spain, and my intention here obviously is not to really to set up a straw man, but to add some perspective, since investors such as ourselves will inevitably regard both countries in the same breath, for the obvious reason that both Spain and Italy, as well as the larger countries in Europe, are the few that are large enough to offer scalable or large enough opportunities for investors like GIC. So what do we have going in Italy's favor, the positives? Quite a fair bit, as it turns out. Italy's near-term growth trajectory is at least on par with that of Spain, for instance. Looking at the very near-term indicators, we see that Italy's 6-monthly rate of change in the PMI is actually better than Spain and a couple of other large countries. Italy also outperforms on the fiscal side, with an expected primary government budget surplus of around 3% of GDP, based on the IMF's estimates. And this is in fact the largest of any developed nation as a percentage of GDP, and it compares starkly against a 2014 Spanish primary deficit of around 2.6% of GDP. Then there is also Italy's larger current account surplus. Indeed, Italy, Portugal, Greece, and Germany are the only countries in the Euro area now with both a current account and a primary budget surplus, again, based on IMF estimates. Now, it should be clear then that the foundational ingredients are there for Italy to emerge on a much stronger footing from this crisis. But more is needed. I have already mentioned the need for a supportive and a stable political backdrop, but let me now suggest 3 other areas where I think progress could greatly help in lifting investor interest in Italy. Now, the first of these is structural reform. Now, it must be acknowledged that Italy has already made very significant progress in this area, and I will not go into the details, but suffice to note that the draft 2014 budget law, for instance, is quite encouraging. There are sizable reductions in the tax wedge. The government is exploring ways to boost FDI through fast-track laws for foreigners, which was talked about earlier, and to pursue the privatization of state assets. Additionally, there have also been measures undertaken in the labor market to increase flexibility and rigidity. Now, even so, the fact remains that financial markets continue to perceive Italy as having introduced, up to this point, considerably less reform in the labor market than other Euro economies. Indeed, for one thing, we see Italy's unit labor costs as having yet to meaningfully decline relative to other member states. And unfortunately, this leaves the Italian labor market now a relative outlier in terms of its perceived lack of adjustment. Interestingly though, Italy and Spain actually rank fairly similarly on competitiveness rankings such as the World Economic Forum's Global Competitiveness Report. Now, what I find notable, however, is that Italy's position has been on the decline, while Spain's is improving, albeit in a very modest fashion. Now, such rankings are by no means perfect, of course, but the reality is that investors see structural reform, or the lack of it, as an important factor determining competitiveness and thereby growth prospects. Indeed, most assessments of trend growth or potential growth in Italy are not the most encouraging. But this is not carved into stone. Much will depend, obviously, on Italy's ability and willingness to accelerate reforms to boost competitiveness. The second area where markets continue to seek clarity is politics and people. As I alluded to earlier, a politically stable and conducive backdrop is crucial for reforms. Conversely, any sign of political instability will very quickly be punished by markets. Now, admittedly, this is not always fair. Given that the euro area has a monetary but not a fiscal or economic union, it seems inevitable that the region will continue to struggle for some time to come in terms of establishing the euro as a truly democratically legitimate construction. Still, the recent signs politically are encouraging. However, I would suggest that politics cannot be made to work without having the people on board. As recent years have made abundantly clear, a disenfranchised society can very quickly give voice to political groups capable of capitalizing very quickly on these frustrations. And here, I reiterate my earlier point about making people more aware of the single currency's value and benefits. The third potential Achilles heel for Italy is the banks. Loan growth in Italy continues to contract at a fairly sharp rate of around 2% a year, a new low, even though, trudging at close to historic lows, even though it's not as bad as Spain. And Professor Caselli spoke earlier of the lending problems that are related to the SME sector. We also note that Italian banks' NPLs continue to rise past the 10% mark, even as there seems to be signs of stabilization elsewhere in the euro area. And finally, coverage ratios are lower in Italy than elsewhere. Now, as we know, we will next year see a fairly comprehensive attempt at the asset quality review and bank stress tests. Now, from a financial market perspective, I have to be honest in saying that Italian banks are currently perceived as being one of the most vulnerable in the region. The IMF estimates that Italy could face a sizable shortfall of around 53 billion euros, and here I refer to losses that are not covered by provisions. It's certainly encouraging that I think the finance minister has come out to assure us that Italy's banks will not fail the stress tests. But nevertheless, between now and the time of the tests, I think it's important that financial markets are able to see concrete signs of further consolidation in the Italian banking sector, including signs of increased ability to raise capital, a decline in non-performing loans, and some stabilization, hopefully, in bank lending. My time is up, but let me conclude by saying a few things about GIC's long-term perspective. Now, unlike many others, we at GIC, I think, benefit from having a very long-term mandate. Rather than marking to market on a high-frequency basis, we maintain our mainly benchmark our performance on a 20-year basis. Now, this has allowed GIC to take a somewhat different perspective to the crisis in Europe than many other investors. Unlike many others, we actually refrained from undertaking a strategic sell-off of European risk assets during the worst part of the crisis. And this, I think most would agree, certainly went against the grain of conventional wisdom at the time. And this was, again, largely possible because of our long-term approach. Now, as it turns out, our view has been validated by the renewed commitment to the euro by policymakers and politicians alike. However, the next leg of the journey is arguably more difficult. As Europe transitions from the acute phase of the crisis to what I term a more chronic one, and investors such as ourselves begin to reset our views on each of the euro member states, the challenge will be for each country to carve out their own individual destinies in the euro area. Italy, as I argued earlier, is in an excellent position to mark out a stronger course henceforth. In my view, politics, policy, and economics are for once finally pulling in the same direction. It will take further effort and sacrifice, but for much the same reasons as I was relatively more constructive on Europe during the crisis, I'm likewise constructive on Italy's prospects as a long-term investment opportunity. Thank you for your time. I wish you all a pleasant remainder of the conference. Thank you.